To start our curriculum, we decided to start at a very basic level and explain exactly what a bond is. So what is a bond? A bond can be thought of as a loan taken out by a company, except instead of going to a bank, the company obtains funds from investors in the form of bonds. Unlike most loans, bonds can be bought and sold on the open market by investors. A bond is a fixed income instrument that pays investors regular interest payments. Bonds can also be used by states, municipalities, and sovereign governments to finance projects and operations. Although there are many different kinds of bonds, we will be discussing the most common type of bond: fixed rate bullet bonds that are non-callable. Fixed rate meaning the bonds pay out a fixed amount periodically to investors, bullet meaning the principal is returned in one lump sum at maturity, and non-callable meaning the issuer of the bond cannot call or redeem the bond early. Before we go any further, let's define some other key terms related to bonds. Face value. The face value, or par value, is the amount of money that will be returned to the investor at maturity. No matter what price the bond is purchased at, the investor will receive a face value of the bond at maturity. The actual denomination of a bond can vary, but bonds are quoted as per 100, meaning if a bond was quoted at 101, it would be trading at 101% of its original face value. Coupon and coupon rate. In addition to receiving the face value at maturity, investors will also receive the final coupon or interest payment. Coupons are typically distributed semi-annually in U.S. markets, but can also have annual or even quarterly payments. The amount received in the form of a coupon payment is determined by the coupon rate. The coupon rate is the rate of interest the bond issuer will pay the investor on the face value of the bond and is expressed as a percentage. For example, an 8% coupon means the investor will receive 8% of the $1,000 face value of $80 every year. Note that the coupon is quoted in annual terms, so if the bond pays its coupon semi-annually, the investor will receive two $40 coupons per year. Maturity. The maturity date is the date on which the bond's final payment will be made. On this date, the par value is returned and any other remaining amount is paid to the investor, and the bond stops paying interest. Take, for example, a bond issued on March 23, 2021 that will mature 2 years from issuance on March 23, 2023. If the bond has a par value of $1,000, pays a coupon rate of 5% or 2.5% semi-annually, then the payments are $25, $25, $25, and $1,025 in each of the next 4 semi-annual terms, respectively. The bond would be referred to as a 5% bond with a 2-year maturity. In summary, we have learned that bonds are a way for entities to obtain capital. In exchange, investors receive a series of interest payments as well as the face value of the bond at maturity. By understanding what a bond's face value, coupon and coupon rate, and maturity are, we can begin to understand more complex properties relating to the bond and its issuer, and how it relates to our strategy as investors.